It's Austin in the Grand Rapids Stonebridge Financial Partners office. We wanted to provide you a quick market summary for Q3. I hope everyone is gearing up for the holiday season and excited for Halloween. Anyway, on to the markets. The Federal Reserve remained the focus in the third quarter as they finally cut interest rates for the first time in more than 4 years. The aftermath of the Federal Reserve 1.5% interest rate cut has been counterintuitive. Since the rate cut was announced, Treasury yields and mortgage rates have increased over the past several weeks. The rationale for the counterintuitive effect is that as the Federal Reserve cuts interest rates, economic growth expectations actually increase. Lower interest rates mean the cost to service or carry debt goes down, which helps economic growth expectations in the long term. And then long-term Treasury bond yields are usually comprised of U.S. growth expectations plus inflation expectations. As markets look forward with rate cuts and decent economic growth in Q3, the 10-year yields on Treasury bonds have increased. Also, with recent money market rates at a decade high, investors plowed trillions of dollars into these stable investments. As the Fed starts a rate cutting cycle, these money market rates fall and have already started to decline. The beginning of an interest rate cutting cycle is typically the time to move out of cash and take advantage of higher rates before they begin to drop. Historically, fixed income markets have outperformed cash during rate cutting cycles. With bond yields increasing since the September rate cut, now may be a great time to transition any excess cash holdings into the fixed income markets. On to equities, the equity bull market that began in October of 2022 has continued and is now approaching its 2-year anniversary. While the S&P 500 is at all-time highs, the underlying fundamentals, that is strong economic growth or strong earnings growth, has helped justify current stock prices. There has been a lot of focus on the presidential elections and their potential impact on the economy and stock markets. In fact, the 2024 elections topped Investopedia Reader Survey's top fear heading into 2024. While elections can very much have real-world impacts that can positively or negatively impact investors as citizens, history tells us that markets don't show a strong preference for one party or the other. Markets favor political certainty over uncertainty. So while the weeks leading up to an election typically may bring increased market volatility, the final quarter of the presidential election cycle sees the U.S. stock market post positive returns about 80% of the time. The markets prefer certainty so much that gridlock from a divided government historically results in stronger stock market returns than when one party controls. Between geopolitical conflicts, the tail end of the hurricane season, the beginning of the Federal Reserve rate cutting cycle, and the election, it's likely the fourth quarter sees volatility reemerge in the markets. As long-term investors, our duty is to not overreact to short-term market fluctuations, but remain committed to maintaining an appropriate level of risk that aligns with your financial plan. As I mentioned above, we at Stonebridge Financial Partners hope everyone has an excellent holiday season. We are thankful for the trust that you have placed in us and continue to work together to meet our clients' goals.